Let us start with the chapter number 2, Concept and Role of Mutual Funds. It discusses about the concept and role of mutual funds, classification of mutual funds, growth of mutual fund industry in India. A mutual fund is a professionally managed investment vehicle. Practically, one does not invest in a mutual fund but invest through mutual funds. Mutual fund is a vehicle in the form of a trust to mobilize money from investors to invest in different markets and securities in line with stated investment objectives. In other words, through investment in a mutual fund, an investor can get access to equities, bonds, money market instruments, and or other securities that may otherwise be unavailable to them and avail of a professional fund management services offered by an asset management company. Role of mutual funds. The primary role of mutual funds is to help investors in earning an income or building their wealth by investing in the opportunities available in the securities markets. It is possible for mutual funds to structure a scheme for different kinds of investment objectives. Mutual funds offer different kinds of schemes to cater to the need of diverse investors. Various categories of the schemes are called funds. Mutual fund can also act as a market stabilizer in countering large inflows or outflows from foreign investors. Mutual funds are therefore viewed as a key participant in the capital market of any economy. Investment objectives of mutual funds. Various investors have different investment preferences and needs. In order to accommodate these preferences, mutual funds mobilize different pools of money. Each such pool of money is called a mutual fund scheme. Each scheme has a pre-announced investment objective. Investors invest in mutual fund scheme whose investment objective reflects their own needs and preferences. The primary objective of various schemes stems from basic needs of an investor, that is, safety, liquidity, and returns. It is in line with these objectives that the scheme would decide the investment universe, that is, the type of securities to invest in. Different asset classes serve different purposes. Exactly in the same way, the schemes that seek liquidity invest in money market securities, and those seeking capital appreciation invest in equity. Examples of investment objectives. Types of mutual fund scheme. Overnight fund. The scheme intends to provide reasonable income along with high liquidity by investing in overnight securities having a maturity of one business day. Second example is equity fund. To generate capital appreciation income from a portfolio predominantly invested in equity and equity related instruments. A third type of mutual fund scheme is hybrid fund. The primary objective of the scheme is to generate long-term capital appreciation by investing predominantly in equity and equity-related securities of companies across the market capitalization spectrum. The fund also invests in debt and money market instruments with a view to generate regular income. The fourth type of scheme is long duration fund. The primary objective of the scheme is to generate a steady stream of income through investment in fixed income securities. Investment policy of mutual funds. The investment policy includes the scheme's asset allocation and investment style. A mutual fund scheme with the objective of providing liquidity would invest in money market instruments or in debt papers of very short duration. At the same time, a mutual fund scheme that aims to generate capital appreciation over long periods would invest in equity shares. This would reflect in the scheme's asset allocation, which would be disclosed in the SID. However, even within the same asset category, the fund manager may adopt different styles. Example, growth style or value style, or different levels of portfolio concentration. Example, focused fund or diversified funds. Now let us talk about the different concepts in mutual fund. Units. A unit in a mutual fund is a portion of fund's total assets and represents an investor's ownership in the fund. When you invest in a mutual fund, the amount you invest is converted into units based on the fund's net asset value (NAV) at the time of purchase. The value of each unit changes as the fund's NAV fluctuates. Now, how it is calculated? The value of the unit is calculated by dividing the fund's NAV by the total number of outstanding units. Units represent ownership in the fund, similar to shares in a company. For example, if you invest ₹1,000 in a mutual fund with an NAV of ₹50, you will receive 20 units. That is, 1000 divided by 50 is equal to 20. Then comes face value. The face value is a term used to describe the value of a unit in the books of the mutual fund. If a mutual fund issues 1000 units in an IPO at ₹10 each, it collects ₹10,000. If subsequently the value of the ₹10,000 invested goes up to ₹12,000, the value of the unit is ₹12. New investors will repay ₹12 to buy the units, ₹2 being the premium over the face value of ₹10. In order to keep account of the number of units, it is important to assign a face value to a unit. Unit capital refers to the total value of all units issued by the mutual fund scheme. It represents the collective investment of all the unit holders in the scheme. When an investor purchases units in a mutual fund, they are essentially buying a proportionate shares of the fund assets. Each unit represents a fraction of the total assets held by the mutual fund. The unit capital is determined by multiplying the number of units issued by the mutual fund by the face value of each unit. Unit capital represents the overall size of the fund, while the NAV represents the value of each individual unit. Investors often monitor the unit capital and NAV of a mutual fund to assess its growth, liquidity, and performance. These metrics can provide insights into the popularity and size of the fund, as well as the returns generated by the underlying investments. Recurring expenses. Under SEBI Mutual Funds Regulations 1996, mutual funds are permitted to charge certain operating expenses for managing a mutual fund scheme, such as sales and marketing, advertising expenses, administrative expenses, transaction cost, investment management fees, registrar fees, custodian fees, audit fees, as a percentage of the fund's daily net assets. All such costs for running and managing a mutual fund scheme are collectively referred to as total expenditure ratio (TER). As per the current SEBI regulations, mutual funds are required to disclose the TER of all schemes on daily basis on their websites as well as AMFI's websites. What is net asset value (NAV)? NAV stands for net asset value. The performance of a mutual fund scheme is denoted by its NAV per unit. NAV per unit is the market value of securities of a scheme divided by the total number of units of the scheme on a given data. For example, if the market value of the securities of the mutual fund scheme is ₹2 lakh and the mutual fund has issued 10 lakh units of ₹10 each to the investors, then the NAV per unit of the fund is ₹20. That is 2 lakh divided by 10 lakh. Since the market value of securities changes every day, NAV of the scheme also varies on day-to-day basis. NAV of mutual fund schemes are published on respective mutual fund websites as well as AMFI's website daily. A mutual fund may accept applications even after the cutoff time, but you will get the NAV of next business day. Further, the cutoff time rule applies for redemptions also. AUM, Assets Under Management. Assets under management is the total market value of the investments assets that an asset management company is managing on behalf of its investor. AUM fluctuates to reflect the flow of money in and out of a fund and the price performance of the assets. AUM implies the cumulative sum of market value of total securities held in a mutual fund scheme. Mark to market (MTM) is a method used to calculate the fair value of a mutual fund portfolio based on the current market prices of securities in the portfolio. Now let us talk about the advantages and disadvantages of investing in mutual funds. Advantages of investing in mutual funds. Number 1. Professional management. Investors may not have the time or the required knowledge and resources to conduct their research and purchase individual stocks or bonds. A mutual fund is managed by full-time professional money managers who have the expertise, experience, and resources to actively buy, sell, and monitor investments. Then comes portfolio diversification, that is, risk diversification. Buying shares in a mutual fund is an easy way to diversify your investments across many securities and asset categories such as equity, debt, and gold, which helps in spreading the risk. So you won't have all your eggs in one basket. This proves to be beneficial when an underlying security of a given mutual fund scheme experiences market headwinds. With diversification, the risk associated in one asset class is countered by the others. Even if one investment in the portfolio decreases in value, other investments may not be impacted and may even increase in value. In other words, you don't lose out on the entire value of your investment if a particular component of your portfolio goes through a turbulent period. Thus, risk diversification or portfolio diversification is one of the most prominent advantages of investing in mutual funds. Economies of scale. Pooling of large sums of money from many investors make it possible for the mutual fund to engage professional managers for managing investments. Individual investors with small amount of invest cannot by themselves afford to engage such professional management. Large investment corpus leads to various other economies of scales. For instance, costs related to investment research and office space area get spread across investors. Further, the higher transaction volume makes it possible to negotiate better terms with brokers, bankers, and other service providers. Mutual funds give the flexibility to an investor to organize their investments according to their convenience. Thus, investing through mutual fund offers a distinct economic advantage to an investor as compared to direct investment in terms of cost saving. Then comes liquidity. You can easily liquidate units of open-ended mutual fund schemes to meet your financial needs on any business day when the stock market or banks are open. So you have easy access to your money. Upon redemption, the redemption amount is credited in your bank account within 1 day to 3 to 4 days, depending upon the type of the scheme. One more point in between we have left is transparency. An investor is well served if relevant information is available on time. Availability of such information is critical for making an informed investment decision. The structure of the mutual funds and the regulations by SEBI has ensured that the investor gets such transparency about their investments. There are 3 essential places from where the investor can get enough information for making informed decision, that is scheme related document, SID, SAI and KIM. Let us talk about tax deferral. Mutual funds are not liable to pay tax on the income they earn. If the same income were to be earned by the investor directly, then tax may have to be paid in the same financial year. Mutual funds offer options whereby the investor can let the money grow in the scheme for several years. By selecting such options, it is possible for the investor to defer tax liability. This helps investors to legally build their wealth faster than would have been the case if they were to pay tax on the income each year. Tax benefits. Investment in ALSs up to 1,50,000 qualifies for tax benefit under Section 80C of the Income Tax Act 1961. Mutual fund investments, when held for a longer term, are tax efficient. Convenient options. There are many convenient options in mutual fund schemes. The options offered under a scheme allows the investor to structure their investments in line with their liquidity preference and tax position. There are also transaction convenience like the ability to withdraw only part of the money from the investment account, the ability to invest the additional amount to the account, setting up systematic transactions, etc. Investment comfort. Once an investor is made with a mutual fund, they make it convenient for the investor to make further purchases with very little documentation. This simplifies subsequent investment activity. Regulatory comfort. The regulator, Securities and Exchange Board of India (SEBI), has mandated strict checks and balances in structure of mutual funds and their activities. Mutual fund investors benefit from such protection. And the last but not least, systematic approach to investments. Mutual funds also offer facilities that helps investors invest amounts regularly through a systematic investment plan (SIP) or withdraw amount regularly through a systematic withdrawal plan (SWP) or move money between different kinds of schemes through a systematic transfer plan (STP). Such systematic approach promote investment discipline, which is useful in long-term wealth creation and protection. Let us talk about the limitations. First is the lack of portfolio customization. Some brokerages and asset management firms offer portfolio management services (PMS) to large investors. In a PMS, the investor has better control over the securities are bought and sold on his behalf. The investor can get a customized portfolio in case of PMS. On the other hand, a unit holder in a mutual fund is just one of the several thousand investors in a scheme. Once a unit holder has bought into the scheme, investment management is left to the fund manager. Thus, the unit holder cannot influence what securities or investments the scheme would invest into. The other factor for limitations is choice overload. There are multiple mutual fund schemes offered by several mutual fund houses and multiple options within those schemes, which makes it difficult for investors to choose between them. Greater dissemination of industry information through various media and availability of professional advisors or mutual fund distributors in the market helps investors handle this overload. In order to overcome this choice overload, SEBI has introduced the categorization of mutual funds to ensure uniformity in characteristics of similar type of schemes launched by different mutual funds. This would help investors to evaluate the different options available before making an informed decisions to invest. No control over costs. All the investors' money is pooled together in a scheme. Costs incurred for managing the scheme are shared by all the unit holders in proportion to their holding of units in the scheme. Therefore, an individual investor has no control over the cost in a scheme. SEBI has, however, imposed certain limits on the expenses that can be charged to any scheme. The other limitation is no guaranteed returns. You might have heard and read that mutual fund investments are subject to market risk. Read all the scheme related documents carefully. This suggests that mutual fund returns are not guaranteed. They can fluctuate based on market conditions, potentially resulting in losses, particularly in volatile markets. Classification of mutual funds. Mutual funds can be classified in multiple ways. Funds can be classified based on the investment objective. Now let us understand how the mutual funds are classified by the structure of the fund. Mutual fund schemes are structured differently. Some schemes are open for purchase and repurchase on a perpetual basis. Once the scheme is launched, the scheme remains open for transactions, and hence the name of this category of schemes is open-ended funds. On the other hand, some schemes have fixed maturity date. This means that these schemes are structured to operate for a fixed period till the maturity date and cease to exist thereafter. Since the closure of the scheme is pre-decided, such schemes are known as close-ended scheme. Apart from these two, there are a couple of other variants. Now let us understand what is open-ended funds. Open-ended funds allows the investors to enter or exit at any time after the NFO. Investors can buy additional units in the scheme anytime after the scheme opens for ongoing transactions. Prospective investors can also buy units. At any time, the existing investor can redeem their investments, that is, they can sell the units back to the scheme to get their money back. Although some unit holders may exit from the scheme wholly or partly, the scheme continues operations with the remaining investors. The scheme does not have any kind of time frame in which it is to be closed. The ongoing entry and exit of the investors imply that the unit capital in an open-ended fund would keep changing on a regular basis. When an investor invests money in the scheme, new units will be created and thus the unit balance would increase. On the other hand, when someone exits the scheme fully or partly, the units sold back to the scheme would be cancelled, due to which the unit balance of the scheme would go down. Close-ended funds. Close-ended funds have a fixed maturity. Investors can buy units of close-ended scheme from the fund only during its NFO. The investors cannot transact with the fund after the NFO is over. At the end of the maturity period, the scheme is wound up, units are cancelled, and the money is returned to the investors. The fund make arrangement for providing liquidity post NFO through listing of the units on the stock exchange. Such listing is compulsory for close-ended schemes to provide liquidity to the investors. Therefore, after the NFO, investors who want to buy units will have to find a seller for those units in the stock exchange. Similarly, investors who want to sell units will have to find a buyer from those units in the stock exchange. Since post NFO, sale and purchase of units happen to or from counterparty in the stock exchange and not to or from the scheme, the unit capital of the scheme remains stable or fixed. Every close-ended scheme other than an equity-linked savings scheme shall be listed on the recognized stock exchange within such time period and subject to such conditions as specified by SEBI. Experience suggests that most of the time the units trade at the discount of the enemy. This can be understood logically. The buyer has money and hence many options to choose from, whereas the seller has the units through the close-ended fund. This puts the buyer in a better bargaining position. Interval funds. Interval funds combine features of both open-ended and close-ended schemes. They are largely close-ended but become open-ended at pre-specified intervals. For instance, an interval scheme might become open-ended between January 1 to 5 and July 1 to 5 each year. The benefit for investors is that, unlike in a purely closed-ended scheme, they are not completely dependent on the stock exchange to be able to buy or sell units of the interval fund. The periods when an interval scheme becomes open-ended are called transaction periods. The period between the close of the transaction period and the opening of the next transaction period is called as the interval period. Minimum duration of the transaction period is 2 days and maximum duration of the interval period is 15 days. No redemption or repurchase of units is allowed except during specified transaction period. The classification of the mutual fund by the management of the portfolio. Actively managed funds. Actively managed funds are funds where the fund manager has flexibility to choose the investment portfolio within the broad parameters of the investment objectives of the scheme. Since this increases the role of the fund manager, the expenses for running the fund turn out to be higher. Investors expect actively managed funds to perform better than the market. Passive funds invest on the basis of the specified index, whose performance it seeks to track. Thus, a passive fund tracking the S&P BSE Sensex would buy only the shares that are part of the composition of the S&P BSE Sensex. The proportion of each share in the scheme's portfolio would also be the same as the weightage assigned to the share in the S&P BSE Sensex. Thus, the performance of these funds tend to mirror the concerned index. They are not designed to perform better than the market. Such schemes are also called index schemes. Since the portfolio is determined by the index itself, the fund manager has no role in deciding on investments. Therefore, these schemes have low running costs. Further classification of mutual fund by the investment universe. There are equity funds, fixed income funds, money market funds, gold funds, international funds, etc. Here the category name indicates where the money could be invested. This classification may get further specified depending on narrowing the investment universe. For example, with equity funds, we have large cap funds, mid cap funds, etc. Similarly, within debt funds, we have government security funds and corporate debt funds. Now, the classification based on the mutual fund scheme categorization and SEBI regulations. There are 5 broad categories of mutual fund schemes. Within each category, there are many subcategories. These 5 broad categories are A. Equity schemes, 11 subcategories. B. Debt schemes, 16 subcategories. C. Hybrid schemes, 6 subcategories. D. Solution oriented schemes, 2 subcategories. And E. Other schemes, 2 subcategories. Let us talk about the equity schemes. An equity scheme is a fund that primarily invests in equity and equity related instruments, seek long term growth but could be volatile in the short term, suitable for the investors with high risk appetite and longer investment horizon. Equity fund categorization as per SEBI guidelines. Multi-cap fund, flexi cap fund, large cap fund, large and mid cap fund, small cap fund, dividend yield fund, value fund, contra fund, focused fund, sectoral thematic fund, ELSS. Now let us understand how these companies are defined as large cap, mid cap and small cap. Large cap companies are those companies which ranks from first to 100th company in terms of full market capitalization. Mid-cap companies are those companies which starts from 101st to 250th company in terms of full market capitalization. And small cap companies are those companies which starts from 251st company onwards in terms of full market capitalization. Now, according to the SEBI's guidelines and regulations, multi-cap fund has to invest at least 75% in equity and equity-related instruments. Flexi-cap has to invest in 65% in equity and equity-related instruments. Large cap has to invest at least 80% investment in large cap stocks. Large and mid cap at least 35% investment in large stocks and 35% in mid-cap stocks. Mid-cap fund means at least 65% investment to mid-cap stocks, and small-cap fund means at least 65% investment in small-cap stocks. Dividend yield fund means predominantly invested in dividend yield stocks with at least 65% in stocks. Value fund means value investment strategy with at least 65% in stocks. Contra fund means scheme follows contrarian investment strategy with at least 65% in stocks. Focused funds means focused on the number of stocks, maximum 30, with at least 65% in equity and equity related instruments. Sectoral or thematic fund means at least 80% investment in the stocks of particular sector or theme. ELSS means at least 80% in stocks accordance with Equity Linked Savings Scheme 2005 notified by Ministry of Finance. Now let us talk about sector specific funds. Sectorial funds invest in a particular sector of the economy such as infrastructure, banking, technology or pharmaceutical etc. Since these funds focus on just one sector of the economy, they limit diversification and are thus riskier. Timing of investment into such funds are important because the performance of the sectors tend to be cyclical. Example of the sector funds: equity market funds with investment objective to invest in pharma and healthcare sector, banking and finance sector, FMCG fast moving consumer goods and related sector, technology and related sectors. What are thematic funds? Thematic funds select stocks of the companies in industries that belong to particular theme. For example, infrastructure, service industries, PSUs, or MNCs. They are more diversified than sectoral funds and hence have a lower risk than sectoral funds. What are value added strategy and style based funds? Equity funds may be categorized based on the valuation parameters adopted in the stocks selection, such as growth fund identify momentum stocks that are expected to perform better than the market. Value funds identify stocks that are currently undervalued but are expected to perform well over time as the value is unlocked. Equity funds may hold a concentrated portfolio to benefit from stock selection. These funds will have a higher risk since the effect of a wrong selection can be substantial on the portfolio's return. What are contra funds? Contra funds are equity mutual funds that take a contrarian view on the market. Underperforming stocks and the sectors are picked at low price points with a view that they will perform in the long run. The portfolios of contra funds have defensive and beaten down stocks that have given negative returns during bear markets. These funds carry the risk of getting calls wrong, as catching a trend before the herd is not possible in every market cycle, and these funds typically underperform in the bull market. As per the SEBI guidelines on scheme categorization of mutual funds, a fund house can either offer a contra or a value fund, not both. ELSS, Equity Linked Savings Scheme. ELSS invest at least 80% in stocks in accordance with Equity Linked Savings Scheme 2005 notified by the Ministry of Finance. It has a lock-in period of 3 years, which is shortest among all other tax saving options. Currently eligible for deduction under Section 80C of Income Tax Act up to 1,50,000 rupees. Now the second category is the debt scheme. Debt schemes. A debt fund, also known as income fund, is a fund that invests primarily in the bonds or other debt securities. Debt fund invests in short and long-term securities issued by government, public financial institutions, companies like treasury bills, government securities, debentures, commercial paper, certificates of deposits and others. Debt funds can be categorized based on the tenure of the securities held in the portfolio and or on the basis of the issuers of the securities or their fund management strategies such as short-term funds, medium-term funds, long-term funds, yield fund, treasury fund, corporate bond fund, infrastructure debt fund. floating rate funds, dynamic bond funds, fixed maturity plans. Debt fund have a potential for income generation and capital preservation. Debt fund categories as per SEBI guidelines on the categorization and rationalization of schemes. Overnight fund. Overnight securities have a maturity of 1 day. Liquid fund. Debt and money market securities with maturity up to 91 days only. Ultra short duration fund. Debt and money market instrument with maturity duration of portfolio between 3 months to 6 months. Low duration fund. Investment in debt and money market instruments with molecular duration portfolio between 6 months and 12 months. Money market fund. Investment in money market instrument having maturity up to 1 year. Short duration fund. Investment in debt and money market instruments with macular duration of the portfolio between 1 year to 3 years. Medium duration fund. Investment in debt and money market instrument with macular duration of portfolio between 3 years to 4 years. Medium to long duration fund. Investment in debt and money market instruments with macular duration of the portfolio between 4 to 7 years. Long duration fund. Investment in debt and money market instruments with macular duration of the portfolio greater than 7 years. Dynamic bond. Investment across duration. Corporate bond fund. Minimum 80% investment in corporate bond only in AA plus and above rated corporate bonds. Credit risk bond fund. Minimum 65% investment in corporate bonds only in AA and below rated corporate bonds. Banking and PSU fund. Minimum 80% in debt instrument of the banks, public sector undertakings, public financial institutions and municipal bonds. Gilt fund. Minimum 80% in GSEC across maturity. Gilt fund with 10 years constant duration. Minimum 80% in GSEC such that the macular duration of the portfolio is equal to 10 years. Floater fund. Minimum 65% in floating rate instruments including fixed rate instruments converted to floating rate exposures using swaps derivatives. Dynamic bond funds alter the tenor of the securities in the portfolio in line with expectation on interest rates. The tenor is increased if the interest rates are expected to go down and vice versa. Floating rate funds invest in bonds whose interest rates are reset periodically so that the fund earns coupon income that is in line with current rates in the market and eliminates interest rate risk to large extent. Short-term debt funds. The primary focus of short-term debt funds is coupon income. Short-term debt funds have to also be evaluated for the credit risk. They may be taken to earn higher coupon income. The tenor of the securities will define the return and risk of the fund. Funds holding securities with lower tenors have lower risk and lower return. Liquid funds invest in securities will not more than 91 days to maturity. Ultra short term funds hold a portfolio with a slightly higher tenor to earn higher coupon income. Short term funds combine coupon income earned from a predominantly short term debt portfolio with some exposure to long term securities to benefit from appreciation in price. What are hybrid funds? Hybrid funds invest in a mix of equities and debt securities. SEBI has classified hybrid funds into 7 subcategories as follows: conservative hybrid fund, balanced hybrid fund, aggressive hybrid fund, dynamic asset allocation or balanced advantage fund, multi-asset allocation fund, arbitrage fund, equity savings. In conservative hybrid fund, 10% to 25% investment in equity or equity related instruments and 75 to 90% in debt instruments. Balanced hybrid fund, there is 40 to 60% investment in equity and equity related instruments and 40 to 60 in debt instruments. In aggressive hybrid fund, there is 65 to 80% investment in equity and equity related instruments and 20 to 35% in debt instruments. In dynamic asset allocation or balanced advantage fund, investment in equity and debt that is managed dynamically 0% to 100% in equity or equity related instrument and 0% to 100% in debt instruments. In multi-asset allocation fund, investment is at least 3 asset classes with minimum allocation of at least 10% in each asset class. Arbitrage fund scheme following arbitrage strategy with minimum 65% investment in equity and equity related instruments. And in equity saving funds, there is equity and equity related instruments minimum 65%, debt instruments minimum 10%, and derivatives minimum for hedging to be specified in the SID, that is scheme investment document. Hybrid funds. Hybrid funds invest in mix of equity and debt securities. They seek to find a balance between growth and income by investing in both equity and debt. The regular income earned from the debt instruments provide greater stability to the returns from such funds. The proportion of equity and debt that will be held in the portfolio is indicated in the scheme information document. Equity-oriented hybrid funds. Aggressive hybrid funds are ideal for investors looking for growth in their investment with some stability. Debt-oriented hybrid funds. Conservative hybrid funds are suitable for conservative investors looking for the boost in returns with a small exposure to equity. The risk and return of the fund will depend upon the equity exposure taken by the portfolio. Higher the allocation to equity, greater is the risk. Solution oriented and other funds. They are retirement fund, children's fund, index fund, ETFs, funds of funds, overseas and domestic. Retirement fund. It is an open-ended retirement solution-oriented scheme having a lock-in of 5 years or till retirement age, whichever is earlier. This is meant for long-term planning related to acquiring a corpus for retirement. Second, children's fund. An open-ended fund for investment for children having a lock-in period for at least 5 years or till the child attains the age of majority, whichever is earlier. This is meant to invest to build a corpus for the child and their needs in the coming years. In index funds or ETFs, there is minimum 95% investment in securities of particular index. In funds of funds, that is overseas and domestic, there is a minimum 95% investment in the underlying funds. Multi-asset funds. A multi-asset fund offers exposure to a broad number of asset classes, often offering a level of diversification typically associated with institutional investing. Multi-asset funds may invest in a number of traditional equity and fixed income strategies, index tracking funds, financial derivatives, as well as commodity like gold. This diversify allows portfolio manager to potentially balance risk with reward and deliver steady long-term returns for investors, particularly in volatile markets. Arbitrage funds. Arbitrage is the simultaneous purchase and sale of an asset to take advantage of the price differential in the two markets and profit from price difference of the asset on different markets or in different forms. Arbitrage funds buys a stock in cash market and simultaneously sells it in the future market at higher price to generate returns from the difference in the price of the security in the two markets. The fund takes equal but opposite position in both the markets, thereby locking in the difference. The positions have to be built until expiry of the derivative cycle, and both positions need to be closed at the same price to realize the difference. The cash market price converges with the future market price at the end of the contract period. Thus, it delivers risk-free profit for the investor, that is trader. Price movement do not affect initial price differential because the profit in one market is set off by the loss in the other market. Since mutual funds invest own funds, the difference is fully the returned. Hence, arbitrage funds are considered to be good choice for cautious investors who want to benefit from a volatile market without taking on too much risk. Index funds. Index funds create a portfolio that mirrors a market index. The securities included in the portfolio and their weights are the same as that in the index. The fund manager does not rebalance the portfolio based on their view of the market or sector. Index funds are passively managed, which means that the fund manager makes only minor periodic adjustments to keep the fund in line with its index. Hence, index fund offers the same return and risk represented by the index it tracks. The fees that an index fund can charge is capped at 1.5%. Investors have the comfort of knowing the stocks that will form part of portfolio since the composition of the index is known. Exchange Traded Funds (ETF). An ETF is a marketable security that tracks an index, a commodity, bonds, or a basket of assets like as index fund. ETFs are listed on stock exchanges. Unlike regular mutual funds, an ETF trades like a common stock on a stock exchange. The traded price of an ETF changes throughout the day like any other stock, as it is bought and sold on the stock exchange. ETF units are compulsorily held in demat mode. ETFs are passively managed, which means that the fund manager makes only mirror periodic adjustments to keep the fund in line with its index. Because an ETF tracks an index without trying to outperform, it incurs low administrative cost than actively managed portfolios. Rather than investing in an active fund managed by a fund manager, when one buys units of an ETF, one is harnessing the power of the market itself. Suitable for investors seeking returns similar to index and liquidity similar to stocks. Funds of Fund (FOF). Funds of funds are mutual fund schemes that invest in units of other schemes of the same mutual fund or other mutual funds. The scheme selected for investment will be based on the investment objective of the FOF. The FOF has two levels of expenses: that of the scheme whose units of the FOF invest in and the expense of the FOF itself. Regulations limit the total expenses that can be charged across both levels as follows. TR in respect of FOF investing liquid schemes, index funds and ETFs has been capped at the rate of 1%. TR of FOF investing in liquid oriented schemes has been capped at 2.25%. TER of FOF investing in other schemes that mentioned above has been capped at 2%. Gold Exchange Traded Funds (FOF). Gold ETFs and ETFs with gold as the underlying asset. The scheme will issue units against gold held. Each unit will represent a defined weight in gold, typically 1 gram. The scheme will hold gold in the form of physical gold or gold-related instruments approved by SEBI. Schemes can invest up to 20% of net assets in gold deposit schemes of banks. The price of ETF units move in line with the price of gold or metal exchange. After the NFO units are issued to intermediaries called authorized participants against gold or funds submitted, they can also redeem the units for the underlying gold. Benefits of gold ETFs. Convenience. Option of holding gold electronically instead of physical gold. Safer option to hold gold since there are no risk of thefts or purity. Provides easy liquidity and ease of transaction. Gold ETFs are treated as non-equity oriented mutual funds for the purpose of taxation. Eligible for long-term capital gains benefit if held for 3 years. No wealth tax is applicable on gold ETFs. Apart from the above funds, let us look at some other categories. They are fixed maturity plans, capital protection oriented funds, infrastructure debt funds, real estate mutual fund, new types of funds like smart beta fund and quant funds, international REITs. Apart from that, there are real estate investment trust and infrastructure investment trust. In fixed maturity plans, these are the close-ended funds where the maturity is there after the scheme gets over. In capital protection oriented funds, the money is invested in such a way that they provides protection to the capital invested. Infrastructure debt funds are investment vehicles that can be sponsored by commercial bank and NBFCs of India, in which the domestic offshore institutional investors, especially insurance and pension funds, can invest through units and bonds issued by the IDFs. Infrastructure debt funds (IDFs) can be set up either as a trust or as a company. Real estate mutual fund scheme invests directly or indirectly in real estate assets or other permissible assets in accordance with the SEBI Mutual Fund Regulations 1996. SEBI's regulation require that at least 35% of the portfolio should be held in physical assets. Not less than 75% of the net assets of the scheme shall be in the real estates, mortgage-backed securities, but not directly in mortgages, equity shares or debentures of the companies engaged in dealing in real estate or in undertaking real estate development projects. There are new types of funds which are launched by the mutual fund houses, like smart beta funds. Smart beta funds are an extension of the index or ETFs, as they change the basis of the exposure in the portfolio to index using alternative strategies. For example, a fund that tracks an index will have the same exposure as index, and this would mean weightage by the market capitalization. Smart beta strategies rely less on market cap, and this could include things like equal weightage or exposure based on additional parameters. The whole idea of smart beta fund is to improve returns, increase diversification and reduce risk. Quant funds. Quant funds rely on data analysis and numbers usually undertaken by machines to select the securities in the portfolio. There are predetermined models that are created, and these are derived through analysis of past data. The model then runs through the emerging data to select the holdings and make decisions about buying and selling. This takes out the human element in decision making. International REITs, a fund that invests in real estate investment trust abroad, gives an exposure to the investor both to the international funds plus the commercial real estate sector. In India too, the number of REITs being listed are increasingly slowly, and this kind of fund provides a different kind of holdings to those who need such exposure. REIT, Real Estate Investment Trust, are the trust registered with SEBI invest in commercial real estate assets. Infrastructure Investment Trust, INVIT, are the trust registered with SEBI that invest in the infrastructure sector. International funds. International funds enable investments in the markets outside India by holding in their portfolio one or more of the following: equity of the companies listed abroad, ADRs and GDRs of Indian companies, debt of companies listed abroad, ETFs of other countries, units of passive index in other countries, units of actively managed mutual funds in other countries. International equity funds may also hold some of their portfolios in Indian equity or debt. They can hold some portion of the portfolio in money market instruments to manage liquidity. International funds gives the investor additional benefits of diversification, since global markets may have a low correlation with domestic markets, investment options that may not be available domestically, access to companies that are global leaders in their field. There are risks associated with investing in such funds, such as political events and macroeconomic factors that are less familiar and therefore difficult to interpret. Movements in foreign exchange rate may affect the return on redemption. Countries may change their investment policy towards global investors.